Thank you everyone for joining and hello. Welcome to this risk readiness webinar, the latest installment of credit trends and commercial lending presented by ProSight and AFS. We're happy to have Tom Cronin here to present. If you do have any questions, please use the Q&A at the bottom and we will get to your questions as soon as we can. So again, thank you for joining us and I will hand it over to Tom.
Thanks, Ann, and hello to everybody as we near the end of summer. If you were with us last month, you know we're going to do something a little different today. We're going to focus solely on credit quality and solely on CRE loans, so commercial real estate. And to do that, we're going to use our new Credit Risk Navigator webpage that you see up here, the Risk Migration webpage. And just like last month, we'll do a quick orientation on the charts. We'll discuss some of the macro results, and then we'll finish with a more detailed look. Ann, can you hear me?
Yes, 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 I can.
Okay. Just somebody said they couldn't hear. Finish with a more detailed look at the a couple of property types. A quick comment on our methodology, how we developed this. So we're examining a 12-month period. Today, we're looking at June 2024 versus June 2025. And the borrower has to be present with a valid risk rating in the beginning of the period and at the end of the period. So they have to be there June 30th of 24 and also there June 30th of 25. And there are four ways to look at the data that you see up here. C&I borrower, C&I net book balance, CRE count borrower, which is what we're going to look at today, and CRE net book balance. So let's do a quick orientation of the charts so you see what's here and what's available. We're going to start in the upper left. This is the pass to criticize and criticize to pass chart. There's a column for each property type, the major property types, and we map every bank's native borrower risk rating to the RMA, the ProSight 10-point scale. Borrowers rated 1 through 6 are pass rated. Borrowers rated 7 through 10 are criticized, and that's your typical regulatory definition of special mention, substandard, doubtful, and loss. And the percent of borrowers that declined in credit quality and went from pass to criticize is in the red of each column. And the percent of borrowers that improved and went from criticize back to pass is in the green. The chart right below that, our downgrade upgrade chart, very similar to the pass to criticize chart. This is sorted by the highest downgrade and covers any risk rating movement. So this is the first chart is pass to criticize. This could be anything. So it could be going from a 1 to a 2 or a 5 to a 3. And again, there's a column for each property type. The red is a downgrade. So that would be if you went from a 5 to a 7. And the green is an upgrade if you went from a 4 to 3. The bottom chart is the downgrade upgrade trend chart. Right now, it just has a single entry here. As we populate this with more months, this will grow. So there'll be a column for each month. But this is basically takes what you saw above and summarizes it at the all property level. If we move over to the upper right, you see the distribution by migration events. What this chart is showing you, again, is movement. The positive numbers to the right, that's bad. So that means a rating went from 5 to a 6 or a 7 to a 9. The negative ratings, the ones on the left, are good. It's kind of counterintuitive. And that's a decrease. So that's like a 7 to a 5. The next chart, actually the matrix, this is what we call a risk migration transition matrix table. Let me explain what's here and how to read this. Going down the far left column and then across the top are the risk ratings 1 through 10. The downward column is the risk rating as of June 2024. The row, the 1 through 10 across the top, is the risk rating as of June 2025. So if you look at the intersection of the fives, if you take the 5 from the vertical column and come over to the right and you see 82.4% under the other fives, that means that 82%, we'll just call it 82% of the borrowers that were risk rated 5 are still a 5 a year later. And then if you go over 1, 8% of the 5s are now a 6. So that's how you read that. We'll get to this one in a little bit more. And then the last chart is percent criticized. This one's fairly straightforward. It shows the percent criticized for every property type, and it's only for the current month. It is not a June 24 to June 25. So this is just a 1-month time frame. So let's see what these charts are telling us about CRE quality over the past 12 months. And we're going to look at it from a macro standpoint first, and then we'll examine a couple of individual property types. And I want to start back on the upper left on the pass to criticize and criticize to pass chart. And a couple of just observations. So every property type has a larger percent of pass to crit, the red, than the criticize to pass. Now, residential looks like it's close. It looks like it's showing 1-to-1, but actually that's just due to rounding. There's actually more pass to criticize. The largest crit to pass, so coming back to being good, is 2%. And there are 3 property types, you can see on this here right in the middle, that have a pass to crit ratio, criticize ratio of over 4%. So you're definitely seeing a major shift downward in credit quality with this pass to criticize chart. If you drop down one chart to the downgrade upgrade, so again, this is the chart that it doesn't really care whether you're going from a pass to a criticized category, just any movement at all. 6 property types have downgrades of 10% or more, and only 2 property types have upgrades of 10% or more. And the only healthcare has more upgrades than downgrades. Every other property type is showing more downgrades than upgrades. So again, these macro results are indicative of an overall decline and somewhat significant decline in CRE credit quality. Let's slide over to the macro, to the matrix chart. And I want to try to see if I could pull this up. Now, bear with me a second. So I'm going to show this as a table so you get a better look at it. So this is all CRE borrowers. And what you expect to see, again, if you were with us last month, what I says, what you expect to see is that the tails are relatively constant. So the 8, 9s, and 10s are in the 90s and 100s. That's what you expect. The 1, 2s, and 3s, you would expect those would be in the 80, 90s. If a loan is a 1, you wouldn't expect it to change very much. Same with a 2 or a 3. But what we see is a lot more movement, a lot more downward movement with the CRE loans, much so more than we saw with the CNI loans. For example, if you look at the 1-to-1 for CRE, it's 62%. So 62% of the ones stay to 1. For CNI, that number was 92%. You look at the 2s, 54% stay to 2, whereas for CNI, it was 80%. And then almost 25% of the ones went down 2 notches or 1. So, pardon me, they went from this 1 to the 3, 4, 5 down that way. And again, the ones, if you need it, I can send you the definitions. The ones are the most pristine credits, and the credit quality is impeccable. And for that to drop in a year's period, 25% of those to drop at least 2 notches is really outstanding or highly significant. If you look at the 2s, over 25% of those went down 2 notches or more. So again, indicative of very dramatic shift in the overall CRE quality. In the brochures that we have with this, we talk about using the matrix to identify ratings drift. I don't see this as really drifting. This is more of a a tsunami type change, if you would, for not trying to be over dramatic. So let's go take a look at some select property types. And we're going to start with lodging. And I'm going to start with the pass to criticize, criticize to pass. And I'm just going to click on lodging. And let me bring it back. Oh, give me a second. I was out too long. So what we'll see in a second, here at lodging, let me go get CRE borrower. I'll start with lodging. So I'll highlight lodging and we can look at just the statistics for lodging. The pass to crit and the crit to pass isn't too bad. Criticize to pass is 2%, pass to criticize is 3%. So just a little bit more pass to criticize. So not really too bad. But if you come down to the next one, look at downgrade, upgrade. You can see the downgrade is 18%, while the upgrade is only 11%. So much more activity here for lodging going down. If you come over to the matrix, it's even worse than what we saw at the high level. You have, for ones, this was lodging properties that were rated a 1. Only 10% of those are still a 1 today. And 60% have dropped at least 2 notches, and 10% is all the way down to special mention. And again, I'll send you the definitions if you need it, but 1 is a pristine quality lodging facility. So for it to drop in 12 months from pristine to special mention, it is saying something. A little bit of 30%, a little above 30%, pardon me, stayed as a 2 or a 3. So again, a dramatic shift here to the right and downward. And about 55%, particularly of the 2s, are dropping 2 notches or more. So these aren't little, little changes in definition, little changes in rating. These are significant movements. And with the exception of the 9s, where actually 1 came back from doubtful to pass, the matrix, the pass to criticize, and the down up charts are all showing seismic shift. I call it seismic shift downward in credit quality for lodging. And why is this happening? So what are we hearing? A couple of things. First of all, operating costs are rising and outpacing revenue growth. Labor and energy expenses are up. Things like complimentary services like free breakfast is up. One of my favorite places of staying is Embassy Suites, and you get a nice free breakfast, cook to order pancakes and omelets, and then manager's reception at night. All those things are getting more expensive. And then you have a slowdown in demand, especially international. In the first quarter of 2025, bookings from Canada were down 30%. And then finally, you had the increased competition from alternative lodging options like Airbnb and Vrbo. So a lot of headwinds here with lodging. Let's look at another one. Let's go over and take a look at multifamily. And the pass to criticize here, a little bit worse than what we saw with lodging. Here, that's 4-to-1 pass to criticize, criticize to pass. So a lot more multifamily properties going into the criticized bucket. If you look at the downgrade upgrade, so 11% downgrade, 9% upgrade. So almost 50-50, but still trending towards the wrong side. Come over to the matrix. And again, as I said, you expect the tails to be kind of consistent. The end tail is, but the front tail is not. You only have 50% of your borrowers, multifamily borrowers that were risk rated a 1 are still a 1 today. 20% went down 1 notch, but then you have a hefty amount that went down more than 2 notches. Same thing with the 2s and the same thing with the 3s. So these are all, and I hope I'm not being over dramatic, these are all supposed to be really good credits. And to move 50% of them, one notch, two notch, three notches in just a 12-month time period really shows a significant change or an attitude towards what's happening with this industry or these property types. And there's a couple reasons we're hearing this. First of all, the absorption, very not overly built, but heavily built. A lot of people building multifamily units. Um, the absorption is very strong, but there's about 1 million units that are under construction as of July 2025. So this buildup is keeping the rents down. And the rents are being kept down in the face of increased costs to build properties. Both lumber and labor and regulatory issues. And then the economic uncertainty is also negatively impacting the rentals at the higher rates, the Class A properties. So there's a lot of, the properties are getting rented, but then the rents aren't as high as they expected and the costs are not being covered. And we're seeing some particular, and this is according to Yardi, we're seeing some particularly high negative rent growth in areas that used to be fairly attractive, the Sun Belt areas such as Austin, Texas, Phoenix, Las Vegas, Dallas, and then Denver. I know Denver's not in the Sun Belt, but it was a popular market. So let's look at one last property type. And this is, I'm going to leave you with something positive. So here's healthcare. And you can see that pass to criticize is 3%, criticize to pass is 2%. So almost break even, if you would. But then the downgrade upgrades. So if you come down to that chart, 10% were downgraded, but if I land on it right, 13% were upgraded. So this is the only property type where you're seeing more upgrades than you're seeing downgrades. If you go over to the matrix, 1-to-1 stayed 100%. There's a little bit of an issue with twos. Some came back, but again, you have a little drift, so to speak, to the right here. But the threes are in the 80%. Same with the fours and fives. So you're seeing things that make a little bit more sense. And then even if you come down to the eights, you see the 80% where eights are still eights, and some of those eights have actually improved. So the healthcare properties are kind of, I guess you'd say, the shining star. And a couple of reasons, really one primary reason is the demographics of the United States. The group of people who are age 65 plus, like myself, are growing more rapidly than the national average. And older people, very frankly, require more medical services and facilities. For example, there's a predicted rise in diabetes. There's more focus on mental health, and there's an increase in demand for outpatient care. So this is all leading to medical office buildings being built and being full. The only issue or negative comment that anybody has is that there is a labor shortage, particularly on the nurses and skilled care. So that would be the main drawback as to why maybe some of these loans are dropping. So that's it for what we have today. I did want to bring up, again, the 10-point scale. So you can see why I was harping so much on the ones, twos, and threes. Ones are supposed to be substantially risk-free. The twos are the highest quality, and then threes are very good asset quality. So you would not have expected those to have any problems. So Ann, I'll turn it back over to you for any questions.
Great, thank you. I am not seeing any questions right now, but I'll give it a minute or two to see if anybody does add a question into the chat at the bottom of their screen.
Well, while we're waiting, I would say if anybody wants to see the matrix or the downgrade upgrade for a particular industry or a particular property type, please feel free to reach out, email or give me a call, and I'll see what I can get for you if there's something that I didn't show you today or last month that you're more interested in.
Okay, great. I'm not seeing any other additional questions, so thank you so much, Tom. Always appreciate your insights, and it is interesting to see some of this in the new format. Thank you everyone for joining, and we do look forward to having you at our next session, which is going to be October. Next session is a user group, correct, Tom?
Correct. Yeah, October is our semi-annual user group meeting.
Exactly. So great. Well, thank you everyone, and we will see you next time. Have a great day.
Thank you.